Hello and welcome to Business on the Wire. In an unsurprising move, the Reserve Bank's Monetary Policy Committee has voted unanimously to leave all rates unchanged. So, repo rate, reverse repo, MSF, bank rates all stand as is. And the committee also said that their stance remained an accommodative stance, which basically means that they are open to considering cuts if required later in the year. Now, just for some context, this was a delayed meeting, and by and large, most economists expected it to be a status quo event. The newly constituted team, which now has 2 or 3 new members, is more dovish in its approach, and some of the new members have actually been very vocal proponents of encouraging liquidity and anti hawkish moves. At this point, the Reserve Bank didn't seem overly concerned about inflation. The RBI Governor Shaktikanta Das said their estimate was that inflation would ease closer to their own target by Q4 FY21, the end of the financial year. In terms of slicing this up for who got what, there was a lot for the bond market. It seemed like the Reserve Bank was really working hard to, call it a truce with that particular market. The important takeaway also is that the RBI will conduct OMOs, or open market operations, in state bonds. That could be with an eye to the current storm in the GST space. There's also, importantly, some relief for the shadow banking industry, where banks can lend to housing finance companies, NBFCs, from bonds or through loans, and there are some minutiae in that. 24 RTGS now, which is a good development, and I think in that regard, India has actually done quite well for itself. Housing loans have been given preferred status in a sense, where the Reserve Bank says risk weight of housing loans can be as low as 35%, depending on a couple of other parameters. My only concern here is that housing is being pushed at the expense of others, so I'm not sure what they're weighing off. What worried me a little bit was the governor striking a quite odd note with the booming optimism in his statements, surrounding growth. He said financial conditions continue to remain benign, deep contractions of Q1 are behind us, the rural economy looks resilient, undeterred by the pandemic, and that Indian economy was entering a decisive phase. Now, rural economy at this point still remains quite inconsistent in terms of data, so I'm quite worried about what he had to say. And I think at this point, a note of far more caution would have been good. In fact, extremely surprising was the fact that the Reserve Bank governor pointed to the fact that perhaps by Q4 itself, you would see some recovery coming through. At this point, I don't know of a single economist who's talking about recovery as early as then. Sequential GDP growth, will show up better, but that's a function of the base way coming off. So perhaps by FY22, we could see some growth against extremely modest and not good enough. While it's good to see the Reserve Bank governor sort of patting the market shoulder and saying that they're there, it's all going to be okay, I think at this point there is limited armor for central banks globally and otherwise. In fact, globally, many of them are running out of the solutions they have. So the base case remains that a convincing economic recovery cannot take place till a country has effectively tamed the virus. The economic parameters remain poor, whether it is rural, which is inconsistent, or India, where in fact, urban India, where in fact some of the numbers are up and down. Auto numbers, for instance, that have been talked about are a function of pent up demand during Shraddh. The base keeps changing, so it's tough to say. And I think some of the other, ready indicators or quick indicators that the Reserve Bank is looking at also need far more analysis and far more stability before we take, a call on what's happening. So while there was a lot of "we got this" coming through from the Reserve Bank's note, I would still be extremely cautious. I would also be cautious about not conflating what happens in financial markets like the stock market or the bond market with what is the reality on the ground. While the equity market and the bond market may be very well fared and cozy at this point in terms of liquidity availability and a benign environment, the economic distress on the ground is a very, very different situation. The unemployment numbers are as well. And even on inflation, frankly, I would be an extremely cautious, onlooker to what's unfolding over there. This is unseasonal increase in prices, remember, and this is pinching households at a time when spending has probably gone down and spending is difficult for most Indian households at this point. So no surprises on the rate cut front. I was a bit surprised by his optimistic tone on growth, and I think I would have liked to hear much more in terms of what this means for the real average person. For example, what's happened with interest rates, fixed deposit interest rates, what's happening with the unemployment situation, what's happening with on-ground indicators of employment and whether that's coming back. Those really would be the bigger problems for me.
To receive instant updates on all videos from The Wire, click the subscribe button and hit the bell icon. Pay to support independent journalism. Click the link in the description and choose the amount you want to pay.